That's it. No, sorted.
Sorted.
It's right on board.
Well done here. Perfect. Okay, so tax consequences of a closed company. So your first one, payment of private expenses and benefits by the company to participators not employed by, that's the important thing, not employed in the company. And the second one, the receipt of assets under value are treated as a distribution. So if you've got an asset inside the company, okay, and you've got mother and father, and they want to give it to their child, and it's valued at 500,000, okay, if you were to sell it, but they just give it to them for paying no money, then they're actually getting an asset out of the company, and there's a problem inside there we have to actually deal with. Okay, so for the company, the amount is added back in the corporation tax computation. So when you pay private expenses to a director not employed in the company, the amount is added back in the corporation tax computation. The company must pay dividend withholding tax on the gross distribution at 20%. And then what you can get is this distribution is deducted as distributed income in the event of the company being subject to a surcharge on undistributed investment and rental income. Okay, so the consequences are you can't claim it as an expense. Okay, so if you were asked what are the consequences of the first one here, the company can't claim it as an expense. They actually have to pay a distribution on it. Okay, but they are allowed to claim it as distribution when they're doing their closed company surcharge if it applies. And then for the individual, for the director getting it, income tax is paying at the individual's marginal rate, which could be up to 41% under Schedule F. Okay, and you know the distribution is your Schedule F. It's like you're paying a dividend out of the company. Okay, think of distribution the same as a dividend.
The income tax is paid at the marginal rate?
Yeah, 41%. So when you get a dividend, a Schedule F dividend, 20% tax is after being taken out of it. But if your band is over the 20% and you're on to 41% tax, you can pay 41% tax on that dividend.
Put that on after.
Yeah. So like we always do it. We always do it like that. You always pay up to 41% tax on your Schedule F income. And you pay PRSI and you pay USC. So you're looking up to 52%
after
tax.
your 18,000 threshold, is it?
No, the threshold is 32. If you're single, it's 32.8, and if you're married, it's 41.8.
Okay.
Yeah.
The figures will go off.
They haven't changed. No, they haven't changed. It's 15. Yeah. We won't have to worry about that.
Then we pay for the side
and USC, yeah. And if you're paying 41% tax, you're going to be paying the 7% for the higher USC as well. Okay, so the tax consequences for the company and tax consequences for the individual. And this actually comes up as a theory question and as a numerical question as well. Okay, so there's an example now. If you go to the next one here, Generous Limited, a closed company, gave €1,500 to a shareholder to go on a cruise. The shareholder is neither a director nor an employee. Okay, so they're a shareholder in the company, but they're not a director, they're not an employee. So if they were an employee, you charge it as a benefit in kind to them, but because they're not an employee, you have to take dividend withholding tax off of it. So they will be paying €1,500 less 20% tax on it, and that has to be paid over to the revenue of that 20% tax.
Is that IT, income tax?
No, corporation tax. It's called DWT, dividend withholding tax. Yeah.
Okay.
And just have your date. Say they paid that shareholder that money on the 31st of May. It was paid over to revenue by the 14th of June. So the 14th day of the following month. Okay, so your consequences for the company, they're paying dividend withholding tax on €1,500. They must add it back in their corporation tax computation. They're not allowed to claim it as an expense. And they must pay that distribution over to the revenue by the 14th day of the following month. Okay? The tax on that distribution.
Yeah, so if they've given 1,500, you work it back.
Yeah, 15, you take 1,500. Yeah. Yeah. Okay, is that alright? Okay, that's what, if you were paying the expenses, if you're paying that expense to someone who's not employed in the company. If that €1,500 had been paid to the director who is an employee, you'd put it through his salary and treat it as a benefit in kind. Okay, so that's our generous. Okay, our next one then is a transfer of assets and undervalue to participators and their associates. Okay, so you have the implication for the company is there's a corporation tax on the deemed disposal of the asset. There is dividend withholding taxes payable on the deemed distribution, and that's what I mean here. The dividend is payable on the deemed distribution. It's on the undervalue. Okay, so say the market value of the property is 100,000. Okay, and they paid you 40,000 for that property. Then you've got a distribution of 60,000. Okay, so do you want, if you want to bet alongside it, what you mean by dividend, DWT is payable on the deemed distribution. So it's on the undervalue of the property. So the market value was 100,000.
And sold for.
It was, yeah, the director gave the company 40,000 for it. So there's an undervalue there of 60,000.
And that's the deemed distribution.
And that's a deemed distribution then.
And that's paid at the marginal rate.
Yeah, by the individual himself. The company will pay 20% tax on it, and then the director, when he's doing his income tax computation, will pay up to 41% tax on it. So you have two lots of tax to look at. You've got the company's point of view, where they'll pay 20% tax on the distribution, and then the individual, the director, when he's doing his tax computations, he'll pay 41%
On the 60.
on the 60. Yeah.
And
40.
No, on the 6. The 40, you have to take into account for a capital gains tax. Because the company got 40,000. Yeah, yeah.
The company will be paying for the 40,000.
No, the 40,000 they looked at as being going to capital gains tax side of it, CGT. But the 60,000, they have to pay out like a dividend and pay 20% tax on that, which is what, €12,000.
It's like they had to pay, it's like they had money back to pay.
They have to pay 12,000 out to the revenue.
They have to pay, the company will have to pay CT and the full 100,000 then, is it?
No, because it's an asset they've taken out of the company.
Yeah.
So they would put in to their capital gains tax computation the 40,000, and it cost them 100,000. So they actually will have no, capital gains tax.
Yeah.
But they still have to pay money.
The first point there is CT and deemed disposal of the asset. Is the first point there just?
They won't let it back, is it?
No, the CT on the deemed disposal of the asset.
Oh yeah, that's because if you've got a capital gain
Yeah.
in corporation tax, it's treated as corporation tax.
Right.
Where you take the 33% over the 12.5%, and you pay corporation tax on that.
And that'd be on the 60,000, is it?
On the 40. The 40.
Sorry, I'm a little confused. The market value is 100.
Yeah.
The
Distribution will be 40.
The
Deemed distribution 60.
The distribution is 60, yeah. Take your 100, take your 40 off it, and distribution is 60. So it's on the 100,000 the capital gains tax we worked out.
Yeah.
The 100,000, okay? Because, Jimmy, I know we haven't done capital gains tax yet, but if you've got capital gains tax, right, and you dispose of a building to your son, okay, just say, right, and it was, the market value for that date was 500,000, your son only gave you 100,000 for it, okay, you don't pay capital gains tax on the 500,000, even though you only got 100,000 for it, because it's the market value of the asset when you sell it.
So
Okay.
in this case, three taxes arise.
There's two taxes arising. We'll go through it. So you've got the 100,000 will be the company paying capital gains tax on it.
Because they've gained, even though they've only gained 40.
They've only gained 40
They're taxed effectively to CGT
on
CGT.
the 100,000. On the 100,000, yeah. Then they have to, on the distribution, which is the 100,000 less the 40,000, you're left with 60,000. They have to pay 20% dividend withholding tax on that.
That's it's as part of corporation tax. dividend withholding tax is part of the corporate.
And it's like what a company pays on their dividends. So take any company like Kerry have a distribution at the end of the year. They give out their dividend at the end of the year.
Like
so,
most PLCs. Like,
yeah, so like if they give out €1,000 of a dividend, they take 20% tax off it, and they pay the person who's getting, the shareholder who's getting it, €800. So that's what the 20% is inside there.
Right, okay.
So the CGT, DWT, and then paying corporation tax then on 40.
So the 20% dividend withholding tax is paid on the 60,
The 60.
and the individual then, the third tax is the income
Individual
tax.
will pay for 41% tax on the 60 as well. Yeah.
Okay, so
So Stuart,
On the
it's
60 is two taxes.
two taxes. But it's from the point of view of the company and the individual. The company and the shareholder, if I should put it like that. Okay, and Stuart, it's the 100,000 is the capital gains tax, but inside the company you don't pay 33%, so you pay the 33 over the 12 and a half, you have to adjust it up. So that's why it says CT on deemed disposal, because a company doesn't pay capital gains tax, it pays corporation tax, so 33 over 12 and a half.
the deemed disposal being 60.
No, the 100.
Oh, sorry, the 100.
The 100.
Right, yeah. The market value.
Yeah. We go through that again? Okay, so you've got the 100, so the building is 100,000. Okay, the building inside there, if he was to sell, if the company was to sell that building in the morning to a stranger, they get 100,000 for it. But they've sold it, that's the deemed disposal, okay? Then if they were to sell it to the shareholder, they only got 40,000 for it, but they have to pay the capital gains tax on the top of 100,000. The 40,000 is ignored. Okay?
So the company pays on the 100 and the 60, and the individual pays on the 60 and 40.
No, the individual won't pay the 40 at all.
If he got 40 for it.
Well, if you got 40 for it down the line, do you know what I
You're
mean?
only paying 60 now at the moment.
60 now at the moment.
Because that's what he's been.
That's what he's paying.
He got the benefit of 60,000 by buying it at the cut price.
Yeah.
He's
So
got the
instead of paying the company the
60,000,
100,000, they've paid a distribution of 60,000 to him, so he has to pay income tax on that. Yeah? Yeah? But when we go to another example, there's another example in the question here, hopefully it'll make more sense.
Sorry, he's getting the benefit of 60,000, so he's pay tax on that.
Yeah, that's it, yeah. And you see where there's CT and deemed disposal, if you want to put it like that, a company doesn't pay capital gains tax, it pays corporation tax on its capital gains. That's why you say corporation tax inside there. So a company doesn't pay capital gains tax.
So on the 100 grand,
Yeah.
they actually pay.
It is capital gains tax in one way, but in a company it's called corporation tax.
So do you adjust it up?
Remember we did it there the last time, we adjusted 33 over 12 and a half from the night before.
It's a
That's-
theoretical
So they
figure,
just gains,
yes.
Yeah, chargeable gains.
By the
it's
33
called.
over 12 and a half, so that it becomes.
Remember we did, I'll just do it here.
Yeah.
Remember we had, they had a gain of say 10,000. Okay? Then you have to adjust that by 10,000 multiplied by 33 over 12 and a half. Because 12 and a half is our corporation tax rate, 33 is our capital gains tax rate. So if an individual had this, okay, so say I sold the building and I made a gain of 10,000, I'd be paying 3,300 capital gains tax. But a company has to adjust theirs, so that's what's 10,000. That's 26,400 by 12.5%, which is 3.3. And it's called corporation tax. Okay, and it's called a chargeable gain.
Corporation tax on chargeable gain.
Yeah. Whereas an individual would pay capital gains tax, a company on their chargeable gains will pay corporation tax.
They're the same amount of silver.
They're paying the same amount. Yeah, you just have to. This is individuals gain 10,000, but the companies has to be adjusted to their written an unfair tax system there that they're paying the same amount. The company's paying the same amount as the individual. So you have, whenever you've got a chargeable gain in corporation tax, you have to adjust it up. Yeah?
Yep.
Does that okay?
There's no benefits to 12.5%, so is it?
No, there's no benefit. I don't know why can't they just leave it at the 33? It would be a lot easier, just take 10,000 by 33. Okay, then the base cost of the company shares is reduced by the amount of the asset being transferred. Then the implication for the individuals, you've got the Schedule F, okay, which is at the marginal rate. They could pay stamp duty at 2%, and that's on a commercial property. We'll be going through stamp duty later on, but the 2% applies to a commercial property on the market value of the asset. So they have to pay 2% on that 100,000 in stamp duty.
Because it's commercial.
A commercial premises, yeah. Then there may be VAT in the property. I'm not going into VAT in the property now because we'll be here for the rest of the night. I do that when I'm covering the VAT in the property section.
We're talking property, is it just buildings or can be machinery or?
Just
tax
buildings, yeah. And then it's 1% if it's a residential property, 2% if it's a commercial property. But we'll go through that, I know it's on the stamp duty. And then capital acquisition tax, we'll cover that as well when we're doing capital acquisition tax. But just, if you just know what the implications could be. So for the company, you've got the CT and deemed disposal, dividend withholding tax on the distribution, the base cost of their shares are reduced. Then for the individual, they've got the Schedule F, the stamp duty, they may have VAT on property, and they may have a capital acquisition tax issue as well.
So going back to the 100 grand, 40 grand, 60 grand example, those issues all flow from that example.
From that,
don't they?
yeah.
So implications for the individual and the company.
And the company, yeah. So if we go over the page here now, we have a little example. Okay, which one is it here? Okay, so X, Y, and Z is a closed company which is owned by John and Mary Murphy. Their daughter Anne just finished college and the Murphys would like to reward her for her hard work. They wish to transfer an industrial unit to her from XYZ Limited worth 500,000. The unit originally cost 100,000 in 2008. Okay, so the consequences if it's a closed company. Okay, so is Anne a participator?
Mm-hmm.
Because she's an associate of the mother and father, isn't it? Inside there. Okay, so our consequences. Right, so let's go over here. Just so we can have them written down. Okay, so the consequence for the company first. Okay, so the company has a deemed disposal. Okay, company has a deemed disposal. Okay, that's our first consequence anyway. Okay, disposal for CT purposes would be for CT purposes. Okay, so we take our sales proceeds, and in this case it's our market value, and that is 500,000. Okay, because the market value of the asset, if we're going to transfer it to her, is 500,000. Okay, the base cost. I know this is a CGT, but it'll make more sense when we're doing CGT as well. Base cost is 100,000. Which leaves us with a gain of 400,000. Is that alright? Okay? So the market value is 500,000. We've got the base cost of 100,000, and then the gain then is 400,000. And just work out the capital gain tax and that, so we just will have it. So it's 400,000 multiplied by your 33 all over the 12.5. Okay, because 33 is your CGT rate and 12.5 is your corporation tax rate. Okay, if you multiply that out, $1,056,000. Okay, so you do your 33 over 12.5, which gives you $1,056,000. So now they're going to pay, that's their chargeable gain. They're going to pay corporation tax. On the chargeable gain. So that's going to be 1,056,000 by 12.5%, which is 132,000.
That's the corporation, right, yeah.
Did you check to see if there's reference between?
I must ask Richard yes about that, but there is, because it says it on the thing.
We're fine with that to 2008, but if it was older than the indexation.
Yeah, but there has to be, they have to give you that.
Yeah.
But I'll send an email out to him just to confirm it and get a copy of what they actually give out as well.
Yeah, like, do the institute have much to offer? Because, like, we didn't get a budget briefing or anything at first, like, remember?
Well, are you registered as students?
No.
Yeah.
Yeah?
I'm not yet, I'm waiting
No.
When Richard comes out to see what the situation is.
Yeah, so you can ask him all the questions. When he'll be down next month. Yeah, early, as soon as Gillian is back, he'll be down and he'll go through the stuff. Okay, so that's our first one. The company has a deemed disposal for CD purposes, so you work out what the chargeable gain is. Remember to adjust your gain and you pay corporation tax in on the 1,056,000. The second, or the third one, will be, we've got dividend withholding tax to pay, or the company has dividend withholding tax to pay. On the 500,000,
No.
on the 400,000, sorry. Okay, which will be 400,000
By 20%, is it?
by, no, this will actually be on the 500,000. And why would it be on the 500,000? Because they actually got nothing for it. In my last example, there was 100,000, they received 40, and it was on the 60. This is our base costs, but they actually paid for it. So this is a full gift of 500,000. Yeah, so that's a good thing to think about that. Okay, it's the full 500,000 in this one. So it's 500,000 by 20%, which is 100,000. Okay, so because it's the full, because Anne, is it Anne is her name? Yeah, is not giving anything to her parents for it, and she's getting a building worth 500,000.
So she's given 100,000, she gets.
Yeah, if she had given them the 100,000, yeah, she would pay the dividend on the 400,000 then. Okay, so that's a DWT of 100,000. Okay, and that was paid on the 14th day of the month after the distribution has been made.
That tax is somewhat similar then to the withholding tax that professionals are often charged by state bodies.
Yeah, it's the same thing. It's just called professional
So
services withholding tax.
So in fact, that's what we are talking about.
No, that's completely different. That's if you've got in-kind income tax and an engineer or a solicitor, I use example as a solicitor does free legal aid for somebody. Well, the state is supposed to pay them €1,000, take 20% off of it, and they pay them €800. That's called professional services withholding tax. That's totally different to to this. That's just a completely different tax. This is like if you've got your closed company, it's to stop directors giving people 500,000 of a gift. Okay?
To wipe off the assets.
To wipe off the asset, do you know what I mean? And the consequences for that then. Okay, then the base cost of the shares is reduced by the amount of the undervalue. Okay, just to know if the base cost is reduced, that'll do your base cost of the shares is reduced. So that's for the company. So we've got N's consequences then.
So the undervalue there is full 500,000, isn't it?
The 500,000, yeah. Okay, she's going to have to pay income tax, which is her Schedule F on the distribution. Distribution, and that can be up to 52%, okay, because you have 41% tax, 4% PRSI, and 7% USC. And then she's got to pay stamp duty at 2% on the market value. That's 500,000 by 2%. That 10,000. 1% would be 5,000, so 10,000, isn't it?
Now, when does that become payable?
The stamp duty?
On the transaction.
On the transaction, yeah. And then people say, why can't you go for what's called, we haven't done capital acquisition tax, capital acquisition tax is 33%, instead of paying 41%, 4% and 7% is 52%, and 2% stamp duty is 53, your CAT is only 33, that's not an option. You can't actually go for that inside there. So that's from a tax planning point of view, CAT is not an option if you want to write down inside there. Underneath it. Cannot opt for CAT of 33%. And that will make more sense when we're doing capital acquisition tax as well. Like this now, all the kind of taxes are kind of linked up. There's bits coming from different places.
Why, you say she can't opt for it? Obviously, you could see why she'd want it.
Yeah, but she can't. It's
just
because it's a closed company rule.
If it wasn't a closed company.
It was different. It was only her parents giving her an asset to be totally different because it's the company asset.
Right.
That's where the problem is coming in.
So what in practice will happen is that some mechanism will be found to get it out of the company and into her hands.
Yeah.
Another day's work.
Yeah, and we'll be doing that. We'll be doing a tax planning.
Right.
You know, advising people. That's what this exam is about. Advising people. It's not like we're just learning stuff off and do you know what I mean, repeating it back. It's about advising. It's like there's a big section, and I think it's actually level 3 is tax planning, and it's quite interesting. Do you know what I mean, from a real life point of view as well. Let's save that there. Okay, so that's our first consequence. So we've got the payment of expenses to people who are not employed in the company, and then they taking the assets out. Okay, or what they call it, receipt of assets under value are treated as distribution. So that's a fairly high consequence, isn't it? So I mean, like they have 100,000 worth of a distribution. and they have 132,000 worth of capital gains tax, and they actually got no money for that asset. Yeah?
That's costing her half of what she might as well do.
Well, she having to pay, but she has the asset.
She has 500,000 building,
It's costing her half, isn't
but
it?
it's costing her
250 grand.
100,000 and
It's costing her half.
2%, 110,000.
Costing more, it's costing her 250,000.
Of course, if you look at the 52%, yeah,
Yeah.
500